From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I'm Mike Maxon. That's Brandon Gray. And Brandon is fresh off a trip to New Mexico. Nothing like sending an Alabama boy to New Mexico.
No doubt about it. So yeah, it was a great trip. So got to spend some time in three different locations. So I was in Roswell, Hobbs, and Carlsbad, New Mexico, speaking to the entrepreneurial community out there. Had three great events, got to meet some really cool people. It's fun to travel to different parts of the country and see how those local economic conditions are. As you kind of compare that, and we've talked, at length on the podcast here about the overall entrepreneurial economy. And you had kind of a blend of different things depending on the location. The thing that stood out the most was particularly as you look at like Hobbs and Carlsbad, very tied to the oil industry. So as the oil industry goes, so goes those local economies. And the folks that were there, the entrepreneurs, just about every one of them had a business that somehow supported oil operations. And the other thing that really stood out was the creativity. And you guys have heard us talk about that a lot as well, that the folks who are winning have businesses that are finding creative ways of providing services, products, and delivering on them, and then messaging that as well. So I'll give you an example. You kind of think of the oil fields. So for those who haven't seen what that might look like, just imagine as much of nothing as you can possibly imagine in every direction. It's just desert or barren land. And, you've got these crews out there drilling oil or working on the rigs or the pipelines or what have you. Well, there's nothing around. And so pretty much everything they need has to be taken on site. So it could be delivering water. It could be food trucks. It could be supplies and materials. The roads that go out to the oil fields are dirt roads. Well, they have to be maintained in some way. They're not county or state roads. So just a lot of creative businesses and the things that they were delivering. And it was really cool to see. So anybody that's listening, hopefully we've got some new listeners from New Mexico, because we definitely talked up the podcast while we were out there. Great work, guys. Cool to see.
Awesome. Yeah, hopefully gain some new listeners.
Yep.
Got to push it. So by the way, if you're listening, tell your friends. We're going to start with something that we had on topic, but I just want to, this is Wall Street Journal today. Actually it came out yesterday, but it's Sunday, and so technically it's worth it today on Monday. Article by Ruth Simon. The break is over. Companies are jacking up prices again. Bigger companies placing the blame on tariffs. Smaller companies placing the blame on higher wages and rising or, quote, skyrocketing health insurance costs. Brandon, surprising?
Not surprising. I think the biggest question is, what will the market's reaction be to it? Because on paper, that's the first move that you make, right? Hey, if I'm paying tariffs, if I'm paying higher premiums for health insurance, and I don't think it's just limited to that's the popular topic to throw out there. But pretty much anything overhead related is going up. Well, the first thing I look at is, can I increase my prices? If you are in a necessity service or product, you most likely can, because folks have to have it. Now, you're going to have some bottom feeders, without a doubt. I'm sure they're going to try to take advantage, and you can only play that game for so long. If you're in a discretionary service or business, good luck. You've heard us. We have been talking about this for 12, 18 months now.
Oh, yeah.
At least 12, because I think I made the first LinkedIn post about it back in October of 2024. So
anything that someone can defer.
Yeah.
They can defer it down the road and it still happen. For example, if you do residential tree care, right? Well, guess what? Like, I have that tree in my yard, unless it's got its roots wrapped around my pipes, I can wait to get it cut down. And so it's one of those where anything that can be deferred is being deferred, and businesses have to make up margin somewhere. So, but I will say this, Brandon, when it comes to the wages, I am definitely not surprised because anyone out there with kids, with a family, um, they're already expensive. And go grocery shopping, go what I mean, it's ridiculous. Astronomical. I mean, you're talking $7 for some cinnamon toast crunch. Are you crazy?
No.
I
Well,
mean,
that's where the pinch is really being felt, because I know the article stated that they're increasing prices because of an increase in wages. Relatively speaking, the last 2 years, we haven't seen a tremendous amount of wage inflation. Now, I think that's temporary. Whenever you just kind of look at the demographics and the situation with population and immigration, it's supply and demand. When the economy takes back off, it's going to be ugly. Probably double-digit wage inflation again. We've seen 3 to 5%, generally speaking, across the client base in terms of increases. But the problem is that's not enough there's too much month at the end of the money for the consumer.
here's how I feel about the wage inflation. I agree with you that it may not have gone up, but the problem is that all the baseline went up. So let's say we get rid of higher price Brandon. That the next person you bring in is not going to be like once upon a time he'd be like, oh, I might get a cheaper deal or something like that. The baseline has all risen across the board. So there's no longer like this, oh, I was paying someone $40 an hour and I was replacing it with a $20 an hour person, right? I got a good deal there. That's no longer the case. So the baseline has risen at every position across the board in my view of it.
Yeah, well, kind of what I've seen is it kind of depends upon the role in the industry. So if it's tied in any way to the minimum wage, then it's definitely went up pretty substantially. So, if you're, we got clients that have different fast food restaurants and construction type companies to what have you, to where a lot of times, the wages are going to be a little bit closer to minimum wage. Those have went up substantially. The wages for the trades have went up substantially. Outside of that, that's what I was speaking to, as to you haven't seen as much of an increase. And I would say that in terms of, kind of the marketplace, and I said earlier, depends upon the role. If you're looking to hire someone, I'll throw out one that I've seen a lot, a marketing position for your team. There's plenty of talent available, and there's talent available that is willing to come work for you for not a ton of money compared to the last couple of years, because there's so many available, right? Supply and demand. If you're looking for a cybersecurity expert, good luck. There's not many of them out there. They're difficult and hard to find. Like I said earlier, anything in the trades, if you're looking for a technician, an electrician, I'll say it, electrician, a plumber, HVAC, those kind of things, good luck. Machinist, good luck. So, kind of depends. And I get what the folks in the Wall Street Journal, and you got to write an article that's for all of America. Definitely. I think you can say in general, sure, they have went up. As wages go up, we got to reset our pricing. But I'm kind of, get your popcorn out, sit back and watch, and let's see what the consumer's response is. Because like Mike said, it comes a point to where you're like, if it's $7 for Cinnamon Toast Crunch, we're eating toast.
That's right.
I mean, and we're seeing consumers change behavior. They are without a doubt. So.
Yeah, there will definitely be pushback. I mean, the article even addresses that and names several companies in there that raised prices and lost a lot of Stanley Black and Decker is one of them. They had to raise prices, lost a lot of consumers in the process. So, yeah, it's going to happen for sure. I just know this is that I still don't have anyone who's like, oh man, my prices are going down. I mean,
yeah. Oh no,
I haven't.
No, you especially, and we'll talk about this a little bit more in the future, I'm sure. But as you dissect our 100 company model, if you're a business that is less than 10 million in revenue, it is extremely difficult to leverage overhead.
Yeah, you haven't reached scale yet, man. You're doing all the expensive stuff,
and that number used to be closer to 7.
Mm-hmm.
You could kind of, you got past 7, man. You got to 10, you're in a great position. Now it's, you look at the revenue line on our 100 company model chart, it has continued to go up. Pricing, but not activity.
Hey, remember what I said? Greg wrote that book about the black hole,
Mm-hmm.
2010. Well, guess what? Inflation adjusts.
Yeah.
Inflation adjusted black hole now, man.
Yeah.
Well, all right. Well, let's get into. I'm glad we deviated there. That was nice. Nice lead into. So we will talk about business value plays today, right? And so we talk about this a lot in our presentations. Obviously, Greg speaks a lot on it, but there's 3 business value plays that we're going to talk about. And one of the things that before we name them that you see is you'll get an owner come in and be like, "Oh, hey, I just want to make a lot of money." Okay, well, that's great, and there's a process for that. You get ones that are like, I want to just, I hope Microsoft buys my stuff, right? And then you just got the guy like he's from Center Star, Alabama, and he just wants to run his little business and make a good living and you know shut the door one day or maybe hand it down. But there's plays, and we encourage entrepreneurs, we encourage business owners to think about these plays that we can run in your business, because it really helps you set the stage from a mindset perspective, going, okay, what is my goal here in building this business? And so, Brandon, why don't you give us a rundown? What are the 3 business value plays?
All right. So we talk a little bit about this in Simple Numbers 2.0. And as Mike said, you need to know which of these categories your business fits to, because it's going to drive a couple of things. One is just some kind of expectation as to, maybe not at a detailed level, but when I get ready to exit this business, is this something the market is really interested in? Not to say there wouldn't be a buyer for it, but it could be limited buyers, or your multiples could be a little bit different than a different type of business. Secondly, and probably more so the case, when we finally achieve success, and let me give you the definition I have of achieving success for an entrepreneur. It's whenever we can start getting a return on our investment in the form of taking a distribution or a dividend from it. We've crossed the finish line, folks. We were profitable. We have cash. Our taxes are stuck back. We've been reinvesting in the business. We still have money. It's a terrible problem to have. But when we can kind of cross that finish line, you kind of need to know, okay, how much should I be looking to take out versus what should I be pumping back in? And I'll give you some general rules of thumb as we kind of go through that. And also that somewhat depends upon which of these business value plays, you may call them, that your business has. So we'll go through the first one here. All right. So this is what we call a run to harvest business. And when we say harvest, basically that means harvesting profitability out of the business. It's creating capital. It's creating a mechanism for you to take that money and then and do something with it. And you guys have heard us say for a long time, you get paid for what you do, you get a return on what you own. Okay. And so the average, this is a really cool data point here. The average entrepreneurial company, take a guess at what % return on investment it's generating.
75.
Mike knows the answer to this.
Is it? No, I just said that.
50 is the average.
Oh, okay.
But if you're, who wants to be average, right? Higher performing ones, 75 and above, easily all day and twice on Sunday, right? So comparing that to alternative investments, stock market, 10, 12%, if you're pretty aggressive across time, right? Real estate, 15 to 25, maybe a little bit higher, depending upon what you're doing there. I mean, the entrepreneurial business just crushes those. So the first thing you got to ask whenever you're looking at this run to harvest kind of play is, should I reinvest back into my business? And that kind of goes for all 3 that we're going to talk about. But that's the first question you ask. Should I reinvest back? Meaning I got profit. I can put this back into my business and get a minimum 50% return in the form of profitability on that investment. And that could be everything from marketing, systems, investments in AI, investments in team members, new locations, you name it. Okay. In a run to harvest business, that is typically a difficult play. Not to say you can't make it, but it becomes a little difficult. And here's why. just by nature of the business, it's typically operationally complex. So I'll give you an example. In-home senior care is a great example of one of these.
Oh yeah.
You got a lot, you got a lot of moving pieces, a lot of patients who need caregivers. You got a lot of caregivers. You got a lot of scheduling. You got a lot of folks calling. Hey, I can't come in today. I got to find somebody else to cover my shift. You got new folks coming on. They all have different needs, so there's a lot of complexity there involved. So in those kind of businesses, you're not typically going to get a premium when you exit. You can get a nice multiple and what have you, but you're not likely going to get a 10x multiple unless you're just doing something really special. So as I go to reinvest back into that, I kind of keep that in mind. Instead of for every dollar I put in and get $10, I might get $4 in terms of reinvesting. Also, there's limitations there unless you expand as to, can I find enough caregivers? Sure, it sounds great. Go grow the business, invest a bunch of marketing. Can I find enough caregivers, take care of people? Those kind of things. So all that to say, that's one as that business generates profitability, and they can be extremely profitable businesses that have a low trade capital signature with them, generate a lot of cash. Those are ones I look to harvest the profitability as I'm running that. And I can take that profitability and go and invest in other things,
Yeah, I look at those run to harvest. To me, there's all kinds, but I always think of it as either the overly dependent service-based business to where if you went away tomorrow, someone just absorbs your clients. It's not like buying you, unless you have some sort of proprietary product or service, or you have, I mean, think of a two-person law firm that has 100 clients. I mean, that might be difficult to buy. Now, you're a 35 attorney law firm with everything built out, the sales relationships, the operational, then you got something different. I also think of the run to harvest as a, maybe you're in Center Star, Alabama, right? I don't know where Brandon's at. You got a nice hardware store. You're great. You got a good we all go to Billy Bob's hardware store out there, right? But man, you move that into Huntsville, and now you're competing with Ace. You're competing with Lowe's and Home Depot and everything else. And now it's like, whoa, hey, you might be able to run that profitable business, and then one day just maybe give it to your kid, or
Right.
you shut the door and you go. So that's what I think of when I think of like run to harvest. It's
Right.
like, hey, I got this good business, but man, given the landscape, it would just be really tough to grab an exit. Not that you can't make money though.
Yeah. I'm gonna make all my money. I'm gonna make my fortune from the profitability of this business, not necessarily when it sells. That's kind of the long and short of it. Yep.
Exactly.
So then the
next one's a good one.
This
is the one everybody wants.
This next one's the fun one. So it's what we call harvest to a premium. So just like the first one, it typically has a low trade capital requirement, which means as you're profitable, it spins off cash. But it sells at a premium.
Mm-hmm.
So this is a fun one here because you kind of can get the best of both worlds to a large degree. Many times these are the type of businesses to where you need to get a pretty substantial multiple on profitability in order to exit, because it's generating, a high degree of profitability and there's a marketplace for it. So unless you're just like, hey, I'm ready, I'm done, I'm ready to go to the house, what have you, I don't have a second generation and to take over, or third generation to take over, and I'm getting ready to retire, or I'm getting older, or there's a health issues, all those kind of factors. Then, these are the ones that think of businesses like HVAC, electrical, plumbing, particularly on the home services side, to where you've got a very sticky customer and you have a lot of repeat business. And most likely, this is a key, a recurring revenue stream. So, when you get that new HVAC unit, you get many times 3 months free of Comfort Club. You just call it whatever name you want to, right? And then it's $10 a month or $15 a month, and they come out and service things and make sure things operating properly and tune up the furnace before winter and clean all the drains out, before spring and all that kind of jazz, right? I mean, it's good stuff. I mean, you need to take care of your equipment. You're probably locked in as a customer. And whenever you go to market and you can show that list of all of those Comfort Club customers, the market just drools over it. Plus, it's a business that has some benefit of being able to reinvest back into.
Yep.
I mean,
I was just going to say that these are businesses, everyone, that when we talk about our value builders, when we talk about working with clients, especially when they're going to scale, getting that apparatus of management, of leadership, of systems, of processes, no one understands really the amount of value in that. Because a company wants to come in, or an individual, what have you, and wants to buy you up, that stuff is usually taken care of at that level, right? That adds that next level of value. So like Brandon said, hey, we have the proprietary product or service that everyone likes. We have the sticky customer. We have the recurring revenue stream or the repeat customer stream. And then I look in that business and guess what? These things are built out there. And because they want to come in with that premium and then just tell the owner, have a nice day. We're taking it from here.
So as you kind of look at the formula there, if you think a profit is 100%, well, 40% of that is going to taxes. Okay. So that leaves me 60. So then I'm taking half of that, or 30% of my profit, and I'm reinvesting it back into the business. Once again, that's one that's pretty cool return, especially when you look at it in terms of what it could generate upon an exit. And the remaining 30%, I'm likely going to take out of the business, diversify my wealth personally. Okay. That way I don't have all my eggs in one basket, right? And, you got a little extra cash hanging around, which is not a bad thing. So that 40-30-30 plan works really well in these types of businesses. So 40 goes tax, 30 back into it. Once again, you're holding that 30, you reinvest back into it, a 50% return on that investment. So whether that's a new, hey, we're ready to add another technician or what have you. I got to put them in a van. I've got to outfit the van, all that, or it could be marketing. It could be expanding territory, you name it. Try to get the 50% return, and the remaining 30 I get to take out and do some cool things. Don't consume it, invest it, and grow personal wealth with that other 30. So we like that one. It's just really cool and fun. So the last one is what we would call build to sell. So this is a business that you may very likely have a very high trade capital signature, which means cash flow is negative to neutral. You either have to buy a lot of inventory, wait a long time on receivables potentially, or you got to use a lot of your capital, put back into the business as launch capital, which is basically the losses or the cash I need to fund a project or product until it becomes profitable. Think of software as one of these, at least historically. Now, this is changing with AI. But, you kind of got this great idea, and I can't tell you the number of clients who developed internal software and decided, okay, this is great for the market. And complete aside, but, we went down that path before too. And as we learned, there's a big difference between selling what you do great and selling software. Those are two completely different animals. Okay. But, the typical kind of software business would be, I need a chunk of capital because it has to be developed, right? And you get it developed, it's going to cost you twice as much and take twice as long as you expected. You're ready to go to market. I need a chunk of capital to carry it to market. Okay. I start selling it. And then as I'm selling it, guess what? I have to reinvest that profit back into the business to fix bugs, issues, add new features, put into marketing, and then eventually build up enough capital so that version 2.0 can be developed, right? So it's kind of like you can feel like you're on a treadmill of make a dollar, put the dollar right back in, make a dollar, put it right back in. It's like, man, this thing's eating me alive. When am I ever going to get to take a distribution out of this? Well, build to sell says it all. I'm building it and then I sell for a massive amount of dollars. This is the most risky of the three business value plays.
Yeah, you got to fly close to the sun on this.
Oh, without a doubt, because you're constantly needing capital, right? So it's kind of like I'm in this environment to where I got an elephant sitting on my chest all the time, needing cash, which means I've got a large amount of personal investment into it, most likely, and or a large amount of debt into it. So it's pretty risky on that front. Secondly, I'm counting on the exit. I'm not harvesting anything along the way. I am hoping that what I have developed is valued by the marketplace, that a competitor doesn't come along and kind of take the idea or do a better job with something, that the market doesn't shift, that AI doesn't replace me. There's a lot of risk there, but these are the ones you read about in the publications, to where somebody was like, hey, had this startup, and after 5 years it was doing 50 million of revenue, and I sold it for $1 billion. Is that crazy?
Running at a loss.
Yeah. Those are the crazy stories. And the reason why is because basically someone larger comes in and it's what we call a strip sale. They are only buying your gross margin. They're not going to buy any people, most likely. They've got their own team of developers. They've got their own administrative team. They are purely coming in and buying your idea and your product and your customer base. That's it. And so that's why they get such a premium when they exit. So, I mean, it can be, like I said, it can be a really cool one, but just know the risk as you're going into it. And know that I'm probably not going to pull any money out of it along the way. I've got to put just about every dollar back into it to keep it rolling until I hit cash out, bang. And then we ride off into the sunset with a big sack full of money.
Yes.
Which
you will go bald like Brandon, though.
Oh, yeah. Along the way, it can be rough. No doubt about it. Now, and these are ones too. So, not only just if you're kind of thinking about the type of business you have or what have you, these are some of those stories that you hear where folks have invested in these types of businesses. So as an investor, also apply this same criteria. If you're looking to do some limited partnerships or minority ownership interest or what have you, be a capital partner, angel investor, what have you, into a business. Well, what of these 3 value plays does that business fit into? And what's your purpose behind the business? Because if your purpose is, I want to invest and have an income stream coming in, okay, Run to Harvest could be a great one, right? Because it's cash flow positive, very profitable. It's going to be, mailbox money. You're not going to get a big dollar amount when you exit, most likely. You might get your money back and maybe a little bit on top, but it's not going to be, hey, all of a sudden I made a $50,000 investment and 3 years later I got $1 million. That's probably not going to happen. The harvest to the premiums one, to where I'm looking, if I'm going to invest in that type of business, to from time to time get some cash, a distribution or dividend as an investor. But it may not happen every quarter, because there might be some quarters they have to reinvest more back into that business, which means you as the partner in that doesn't get the check, and you're probably going to get a nice exit at some point in time. The build to sell, be very comfortable with, this is an investment I'm making to where I will likely lose every dollar. But if it hits, I'm going to make a ton of money. So you just got to go into that one eyes wide open. And how much confidence do you have in the service product or what have you? And more importantly, in the people that are running the ship. Cause that can be a fun one, but if you're wanting the mailbox money to show up every month, don't go and invest in a build to sell company, because all your mailbox money is getting reinvested back into it. All right.
Awesome.
Cool.
We kind of covered, I was happy where this went today, everybody. We're going to just talk value plays, but when pricing, value plays played nicely. Thoroughly enjoyed that one, my man.
Yeah. And we want to hear from you guys. One fun thing about the podcast is that you don't know who all's listening and what type of businesses they have and what they're interested in. That's fun, but it's also the hardest thing, as far as that part goes. So, and two, if you want to learn more about working with us, we got some cool things we've been doing. And we got something we're right on the heels rolling out to our podcast listeners. But in the meantime, if you want to go to simplenumberscri.com/contact, that's simplenumberscri.com/contact. You can enter a little bit of information into that form, and we'll give you a call back and kind of give you a good idea of, okay, hey, you're a business that it's a health checkup, right? You're a business that needs that needs a little bit of help. Maybe you're not very healthy. Your business in great shape, or you're a business we need to do emergency surgery on. If you're just kind of curious about how your business looks and how we'd evaluate it, head out there to that website, simplenumberscri.com/contact. Enter a little bit of information about your business, and we'll get back in touch with you and go through, hey, we might need to chat further, or hey, great job, if you're just curious about the health of your business.
Yeah, absolutely. Well, we appreciate you all listening. For Brandon, I'm Mike, and we will catch you all next time.
See y'all.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.